Well, hello everyone. Don Garman here with Lauren Moon and Jonathan Ting, Mirador Capital Partners. I'm not even going to say happy 2022 because I think we would all agree 2022 is off to a bit of a rocky start. And I'll spare you the sort of glib commentary, but we have certainly here at Mirador had firsthand experience with the virality of the Omicron variant. I think we're down to 3 people at the firm, knock wood, myself included, who haven't gotten it. And so, in the midst of all that, obviously the markets have taken a very new feel here as we start 2022, and it's been noticed. And lest we think nobody pays attention to the videos, many people have reached out to say you are overdue, and we would like to see somebody besides just you. So here you go. I wanted to bring on some different perspectives, and I think it's not far-fetched that Lauren has a different demographic client base than our core client base, right? Younger, a slightly different view of the world and view of the markets. And in some sense, Lauren, that has been kind of the group of companies and stocks that captured the imagination in some sense of everybody simultaneously last year, maybe 2020 and 2021, and has sort of been at the epicenter of a lot of the damage. So how do you think about it? What do you care about it? Or is this just a, looking back, no big deal, ho-hum kind of deal? How do you see it?
Well, I think it's hard to look at how so many growth tech stocks have moved and ho-hum about any of it, especially if you own any of it. Most of my clients know, and many other clients know, that we launched a technology strategy in 2020. So this has been very, very near and dear to my heart. Fortunately, kind of how we built out that strategy, we had some kind of ultra growth hedges built in that have paid off. Our companies haven't gotten slaughtered as much as a lot of technology companies out there. But from our perspective, there's so much kind of FOMO that's driven this portion of the market for the last couple of years. Valuations have been in nosebleed territory for a long time. People don't seem to care what they are. They're just excited about growth at any cost. So unfortunately, for a variety of reasons, interest rates ticking up, liquidity potentially going away, or just reality setting in, we're getting kind of a reckoning in this space, obviously. And it's not fun to watch, but I see it as a pretty exciting opportunity to kind of reposition companies that I like that have now taken a 30 or 40% haircut. I like even more. So selling out of some of kind of those value ETF hedge positions I've had and buying into more of what I like, because I do think that the sector will come back. Probably not the whole sector, probably not every participant in the sector, but it will come back. So these are the times where I think the active management and being selective, as you are in our other strategies, again, pays off when we're in this time of excessive turmoil. So it's not fun. I'm getting calls from clients wondering when it will stop. And none of us have.
Please tell me if you know. Please tell me. I want to know too.
Exactly. But
well, we'll segue, Jonathan. I mean, obviously now kind of moving up the, from, kind of the tip of the teeter, or the end of the teeter totter, slightly up. How are you looking at? I mean, we've sort of repositioned mags as we've kind of gone into this over the last 60 days. Doesn't feel like it's helped mathematically. It certainly has helped, but I think it's wise to look past this moment. How are you looking at, let's say, the next? I mean, it's funny. I haven't even printed a down month. Obviously, this is the worst month since March of 2020 when we all Googled where Wuhan was. But are you looking at the rest of this year as a, wash? Oh, it's the second year of a presidential whatever. And, on the calendar, it's going to be terrible. That's what they say. What do you think about that?
As I wrote in the quarterly letter a couple of weeks ago, I think this year is still going to be a good year for stocks, despite the rocky start in the beginning. The fundamentals for the economy and for companies just still look really strong. Earnings trends are still moving up. The interest rate yield curve shows that we're able to withstand higher interest rates. So I think as they come, and as those interest rates start kicking in, investors will start to realize over time, okay, maybe it's not as bad as we initially fear it to be, right? I mean, the market's indices have corrected 10, 15%. And to be honest, the Fed has not raised interest rates or has not indicated that they are going to yet, right? So there's a lot of fear being priced in at the moment. I think once that fear.
Let me interrupt you just one second for those who aren't sort of tuned in. This has been a really wacky 24 hours, but at a point yesterday, and we're not far from that point at this moment, the S&P was down 10 year to date, the NASDAQ down 15, and which the NASDAQ is the sort of technology index that was, very popular, and people tend to like to hold us to either the NASDAQ or the S&P or the Russell, whichever's done the best that year. That seems to be what people prefer to benchmark us to. We look at some kind of combination. So at a point yesterday morning, it was down, one was down 10, the S&P, NASDAQ down 15, and Russell down 20 year to date. It's a pretty savage beating for the 24th or 5th of January. So anyway, very interesting start. So go ahead.
Yeah, it's a very interesting start. And I think that reflects a lot of the fear that's going on. If you look around fundamentally or economically, what's changed? Not much. So it's really around the Fed. What's the Fed going to do with their next cycle, the speed of this interest rate cycle, and the fear that's being priced in around that pullback in liquidity. But as I said, as we go on through the year and as earnings season come and we start to see these companies print and earnings revisions continue to move higher, I think that fundamental narrative will return until the next rate cycle, and then there'll be some fear. So it'll be a sort of rocky year as the market deals with, okay, still strong fundamentals and improving economy at the same time, Fed rising interest rates. But over time, I think that fundamentals will pull through for the year.
Awesome. All right, good. Well, time will tell. So I will share my comments as well for those who care. I think personally that having a two-way market is better for the type of investing that we do and that we're good at, which is, those sort of one-sided, as I've referred to this in many different ways over the videos, this sort of medicine of Fed stimulus that gets applied to the vein of the economy and markets. And you might recall from a couple videos ago, I talked about the patient lurching on the table. Like, this is what a lurching patient on the table feels like in financial terms. And in the past, the Fed has kind of come back to bail out the markets. They come back with some, softening of the language, or, it's almost like I feel like the market is trying to twist the Fed's arm. If you're not paying attention, for the people watching, they're having a meeting tomorrow today and tomorrow, that they will report the sort of, conclusion or the findings of that meeting tomorrow afternoon. So this is a particularly vicious bout of volatility. I think the market trying to signal or trying to put a knife under the ribs of the Fed to say, are you really going to go through it this time to reduce the medication, the stimulus, the bond buying, and all the rest of it? And to add to the drama, we have Microsoft, one of the, I think it's the second, depending on which day you look, or first highly valued company, and many argue the best run company with the exception of maybe Apple on earth, reporting earnings this afternoon. So if that somehow doesn't wow everybody, then of course we're going to be in for more, market cap volatility, i.e. downside tomorrow, if they don't really knock the cover off the ball. But it doesn't, to me, longer term, make that much of a difference, because the core strategy that we use, for those of you who have been around for a while, and I highlight that difference because we have had so many new clients that have kind of come on over the last year that really haven't been through these multiple cycles with us as clients. And I think it's, we really have to take care to help them understand what it's all about for our core strategy, which we call the long view strategy. So I'm going to answer that question directly. What is it all about? And here's what I mean. The long view strategy is down for the year, but it's down less than any index, the S&P, the NASDAQ, or the Russell 2000. So if it's all about outperforming the index, and that's all it was about, then all we would need to do today is sell all the holdings in the long view and buy the S&P, the Russell, and the NASDAQ. And we would guaranteed outperform the indexes this year, even if they were down another 50%. Just the math is the math. So if outperforming the index was the holy grail, that's what you do. It would work perfectly. Why wouldn't we do that? Well, because that's not what it's all about for us. Because we measure two dimensions, always. We measure the return, which is important, but we also measure the volatility required to achieve the return, which I believe is equally important. So, and I'm going to demonstrate what that looks like. So, we just talked about the index, for the year. And if this comes across in the video, this is the MLS strategy. And of course, it's down a little today, but through yesterday, down 6.2. And I think this is key. And again, markets are gyrating, but if this comes across, you can see the S&P minus 174, the NASDAQ minus 264, and the Russell here down 246. So that is clearly painting a picture, and the long view up here at minus 0.90. So that for us is exactly what we strive to achieve. And looking visually here, we literally have minivan through sports car. And visually, that's exactly how those strategies ought to be performing in markets like the markets we see. So as I've said many times, the problem with this long term is believing you have a sports car when you have a minivan, or believing you have a minivan when you have a sports car. Either will perform well as long as you're not changing one into the other constantly, because that sets up a condition. Some people call it market timing, or there's a million different words for the same thing, but that's a condition where you can't win long term. So we try to stay out of situations where we can't win long term. And so in my opinion, the long view strategy is doing exactly what it needs to be doing in a year like this, which could see enhanced volatility. But I said this to somebody else, and not to be glib, in some sense, I don't necessarily care what the markets do, because we know where the market cap of the markets are. And what I want to highlight is, when we come out of this, and we will, it may not be the companies that were the largest coming into it that lead us out. It may be, so we have to be prepared for that, but it may not be. And we also have to be prepared for that. So what I suffer with and enjoy about myself is I don't have a overload of certitude and certainty in my life about what I know will happen in the future. I believe no one knows what's going to happen in the future. Therefore, you have to position your portfolio accordingly. So, so that's my answer to that. I happen to believe that this, on the index level, we will end up with, maybe an okay year. I don't think, again, it's going to depend on how far down we go versus how far back we need to come for it to be an okay year. But I don't necessarily interpret that as meaning we're going to have a bad year on the MLS level. I don't ever have to agree with that, because we have the option of positioning it in a lot of different ways. If no stocks globally do well this year, it will be hard to have a great year. But what we will do better at, which is always what we do better at, is taking less risk, and therefore keeping the math of long-term compounding on our side and in our favor. So I felt like I didn't want to get overly serious, but I felt like it was important at this point for me to get that out for the people who haven't, or who need to be reminded of what is the long view strategy designed to do, and what will it do in all markets, good and bad, forever. That's the answer. And that's why. Anybody have anything to add, or sorry, Lauren.
I think you covered it, Don.
So that might spawn other questions. I recognize that we are newly, once again, interesting and popular to people. And so we will start to do videos on a more frequent interval. I think if we were down to once a month, as you know, things were kind of ho-hum, you know, ripping up, then we will go to every couple weeks, and some combination of not just me, but the three of us will be out in front sharing whatever observations we have. You can always see on the strategy level what securities are coming in and what are going out. And that sometimes is a signal of kind of how our thoughts are changing interweek. But always just send me a text, or Lauren or Jonathan, and you know, with a notice this, please explain. I mean, what we do better than all other firms, in my opinion, is transparency to clients. You know, in the sense that we own the same things. Nobody has to tell me, gosh, you know how much I'm down this year. Of course I do, because I'm down that much too. So all of those things, you know, at least it lets everyone know that we're bleeding the same blood. It's not any more pleasant for us. We don't have some other place we hide when markets get volatile. There is no way out of this but forward, and but kind of understanding how the world might shift and being a part of that shift in a positive way. And I've always said this, being approximately right and wrong all the time is much better than being precisely right this year and precisely wrong next year. That is, you know, it's a recipe for heartache. It blows up the math of compounding, and all of those things are bad for our clients long term. We are all about making sure that we have, you know, what it's all about is having the wealth that you've earned and managed to achieve last and accomplish your goals over life. It isn't achieving any particular benchmark return over any particular interval. So that's, I won't say that one more time. Anyone else have anything to add?
I think the only thing I'll add that I've been talking to clients about is, I know at least I have a handful of folks that have had cash that they've been sitting on in savings and not sure what to do with, or they sold some employer stock at the end of last year. That, you know, we don't know where the bottom is going to be, but we do know that the market's 10, 20, 30% lower than it was a month ago. So
we know you're not buying the high. And for all the people that, you know, we sat and said, hey, let's hold this cash on the sidelines for a correction. This is what a correction feels like. And I think it's interesting. Nobody ever wants to buy when things, you know, when it doesn't feel quite as good. And if things continue to go down another week or 2 weeks, it will feel even worse, and it will be an even better opportunity. So we're long-termers. I mean, I think if I said with 100% certainty that the market will be at another high in 12 months or 18 months or 24 months, and we'll look back on this time as a great opportunity, it's hard to disagree with that, considering nearly every day of all of our lives up until, you know, 25 days ago, we've been at a high. So I think it will be no different this time. And for all the people we've been, I mean, I look at our biggest holding as a firm as cash. Now we're having those conversations with people that like, now we need to start to get excited about maybe doing some stuff forward looking. That's the other point is, you think, oh my gosh, what if the market goes down another 20? Well, what if it does? And then what happens then? Because what that happens then is it sets up a really great period of forward looking returns going forward. So it's kind of like everybody has the mythology of, I want to be out until that point and then be in. Doesn't work that way. It's just, it's not a realistic expectation. And so we do it as we do it, which is really care about what we own and try not to own things that are going to be wrong. And if we feel like we made a mistake, then we get out of those things as soon as we know we did, and move on to something we think is not a mistake. So anyway, anything else?
Nope.
Well said. Appreciate you adding that, Lauren. That was great. Jonathan, Lauren, thank you guys very much. And as always, we appreciate you. Reach out if you have questions, and we'll talk to you next time. Okay, bye.